Hey everybody, JJ here. Hope you're doing well. Just went and picked up some fast food and I couldn't believe how expensive it was. We got 3 bowls here and it was over $30. So you might have saw the name of the company on the bag there. Don't get the guacamole, it's very expensive. Um, Sitting here in the car with my son, just wanted to say thank you for your support. Thank you for coming back to the channel and watching this today. You want to say hi, buddy?
Hi.
Stay tuned for some news. Thanks for being here. Hey everybody, it's Sunday, March 14th, 2021. Let's get into our headline story here. This is not good news, and I think most of you are probably by now not surprised to see this, but it appears that most of Americans are either broke or on their way to going broke. Now, we know even before this recent story here that most people were living paycheck to paycheck. You could say, technically, you could argue that that's already broke when you're skating that close to the line, so to speak. And most people are in debt, unfortunately. Recent article out of Forbes: half of Americans have lost income since the start of the virus shutdowns, while 16% increased earnings. So we see more concentration to the top, in this case, 16%. We talk about the top 10% a lot on this channel, but we do know it's a K-shaped recovery. So we see the top 50% overall doing better than the bottom 50%. And we will link to this Forbes article. Just look down in description. And we'll read an excerpt here. More than half of Americans have lost at least one form of household income over the past year, while others were unscathed or even earned more, according to a new poll showed signs of the uneven toll the shutdown recession has taken on the U.S. economy. Since March 2020, because of layoffs, reduced wages, salary cuts, and fewer hours, most people, 53% in this survey, said they have lost income. So let's say I'm confused here. I turn on the news, CNBC, and other business channels, and they say that there's an amazing economic recovery. Well, it's a recovery for some, especially if you're in these markets, if you're in other assets that are rising right now because of the big push to keep the bubbles inflated and inflated even bigger. More out of this article: a quarter of respondents said they were unable to pay bills last month, and more than a third doubted they could cover an unexpected expense of $1,000. Now, some of the people that are likely in that top 16%, the people that actually earned more, while some people are making more in investments, like we talk about here a lot, other people working at home is a big money saver. You don't have that commute and all those expenses with being in an office and having to order food, like $30 for 3 bowls of food there. You save money by working at home because you can make food at home, which is a little bit cheaper in general. Right? Then the commute expenses, the wear and tear on your vehicle, of course, the fuel, all of that comes with a cost. All right, another quick excerpt out of this article. The divergence suggested what economists call a K-shaped recovery, in which top earners continue to improve their financial situations in a recession and low earners fall further behind, unquote. And we do know a lot of the U.S. economy, most of it is the service sector economy, and that's where we saw the biggest pain in the service sector, especially the restaurant industry, decimated, small businesses decimated, while big, mega, multinational corporations raked in more profits than before the shutdown recession. All right, let's transition a little bit to this story here. Now, we spoke a little while ago about how most Americans are in debt, and most Americans are getting further into debt during this pandemic. Yes, there are some people that are paying off debt, but sadly, most people, as the article mentioned, are getting further into debt, headed in the direction of becoming broke if they're not broke already. But yet we have a Fed representative here, Harker, says that we might raise interest rates in 2023. Does anyone actually believe this? I don't think he even believes it. How can we raise interest rates under record levels of debt? More now than the financial crisis, way more for the average American, more for corporations, the national debt. All right, so you tell me, listeners here, what is going to happen between now and 2023 that is going to allow the central bank to raise interest rates? And here's a quote here from this particular Fed person here. Quote, "We are climbing out of this situation. It is going to be bumpy, unquote. Are we really climbing out of the situation? Or are we just adding more debt on top of debt? And as we talked about a few episodes ago, stimulus checks are not going to get anyone out of poverty. It may help some people for a very short period of time, but considering the cost of living that's not coming down, it's continuing to go up, by the way. Home prices still rising, rents still rising, the cost of food, the cost of medical care, health care still rising, insurance rising. I looked at my insurance budget. Within 10 years, my insurance has doubled on my home. My home insurance has doubled in about 10 years. I have not filed any claims. When I call the insurance company, they say it's because we've had more claims throughout the state and they have to raise it for everybody. And the justification is that they can't just charge the people that had the claims, because when home prices are $600,000-$700,000, they would have to charge somebody that had a fire $700,000 for their claim. So they can't do that. So they have to spread it across the entire population of California. So yeah, my home insurance has doubled, and food prices are going up. Everything's going up. So I feel really, really bad right now for the people that have lost income. And according to that survey, it's over half the people in the country. So it's not looking good. Even with all the stimulus checks and the handouts, people are still headed toward the direction of going broke. And we need to ask ourselves, with someone here like this Fed person right here, Harker, saying that they're going to raise interest rates in 2023, how are people going to handle it? Right? We have record levels of debt. Let's take a look at mortgage debt. This is out of Investopedia. Recent article here. American debt. Mortgage debt reaches 10.4 trillion in the fourth quarter 2020. How are all these people going to handle higher interest rates? Right? We saw record numbers of refinancing, homeowners refinancing to get the ultra low mortgage rates, since mortgage rates are near 50-year lows still. And a lot of cash out refinancing. Cash out refis have surged. We told you throughout the past few years that the mortgage lending was going to increase, that the banks are still going to continue to lend even through and beyond the repo crisis, which they solved by eliminating reserve requirements for the lenders. But we look to the far right here we are again now back to the same levels that we were at before the housing bubble went bust when we look at mortgage originations. Now this breaks it down by credit score, but you can see the huge spike here to the far right. Does this end well? And with all this new debt and lending, how is the Fed going to raise interest rates? You guys let me know. Come back soon for another dose of economic reality. Until then, bulls and bears, stay well, stay safe, stay prepared. Bye for now, everybody. Peace.